Welcome to Power Charting. I am your host, Bruce Frazier. Today, my most critical chart studies now. We can't begin to cover all of the chart studies that could be entirely relevant at this point in time, but I've cherry picked a few. I believe that you're going to find them most interesting and hopefully valuable to you as we go through these very interesting market times. So let's get started. First of all, a chart you have seen in the past. This is the Fed funds and the 2-year US Treasury rate. Now, this is Fed funds through September 1st, but let's go in and look very closely at where we are. We see that the Fed funds really follows the 2-year interest rate for the US Treasuries. The 2-year interest rate keeps rising. And this puts pressure on the Fed to keep rates up and potentially raise them further. And you will see here back in this period in 2018, 2019, that the 2-year started to come off and came off for more than a quarter while rates kept pushing up and then eventually plateaued on the Fed funds before turning down and following the 2-year lower. So the 2-year continues to be lighting the way. As you can see, the Fed has spent much of 2021 and 22 trying to catch up with where the 2-year was. They finally caught up with it. But as long as the 2-year keeps rising, it puts pressure on the Fed to continue to raise rates or to keep them at an elevated level. Now, this is important for a reason I'm going to talk about in a minute, but just keep in mind, you can go back and look here at 2006, 07, you can see rates going up and how the Fed funds followed the 2-year up, here followed the 2-year up, here followed the 2-year up, and this is where we are now. So expect that there is still pressure on rates to go higher. We have another conflict now in the Middle East, Israel with Hamas, and these events can put pressure on crude oil prices to remain high and go higher, which they appear to be doing. And also, it can have the effect of causing inflation to go up because there is, war and conflict is very expensive across the globe. So this is a concern, and war certainly is a very tragic event. Now, let's do a very quick review of the accumulation schematics with the specific intention of looking at the cascading decline into selling climax. And so you see here that prices will go down into a selling climax. Well, this is a very important psychological event because what is happening into a selling climax is panic. Panic, which causes volume to become very high. It causes the spreads to become very wide day to day, week to week, and it also can cause gaps and it generally panicky behavior. This is the point in time when you have news that is supporting or confirming why prices are dropping. It's a very psychological event, very emotional. People tend to, both institutions and individuals, tend to do irrational things into the conclusion of these declines. And this happens over and over again through all of history. And so then we have an accumulation structure. I won't talk so much about that today, but I do want to talk about this notion of the selling climax because we do not want to become involved or caught up in the crowd psychology and to act on that in an irrational way, which when we look back in time, we will maybe regret. So we want to be tactical. We want to be smart about it. We want to be as educated as possible about the way that the psychology of markets work in conjunction with prices and volume. So here we go. Let's keep that in mind as we go. And here we are talking about long-term U.S. Treasury bond prices, which have been going down, down, down as interest rates have been going up, up. And you saw here with the 2-year and the Fed funds, pressure continues to be on rates to go higher. And we have a very large, what we call and let's just, this is a redistribution action here where you have a long sideways action or a trading range after a decline. Rates have been going up and prices have been dropping now really since I think in the 150 area for the TLT. We're using TLT ETF as a proxy for US Treasury bond prices. It's a great tool for that. It's really good for doing point and figure studies also. Now, look what happened. We had a hinge into this area after redistribution formed. We're counting that and counting it across this area, and it gives us a count 82 to 77. And so a little bit lower than where we are now. But recall from our discussion just a minute ago about selling climaxes that the last part of a decline tends to be the one where the investment community ties the reasons to why prices are dropping. And so that very well could be what happens is that they start to be able to rationalize price action, which gives them the wherewithal, the logic, which is not logical, to sell on the news. The problem is the news comes near the lows. And so if the next decline in Treasury prices could very well be panicky, could have selling climax implications to it, and could take us down into this 82 to 77 area, not very far away from where we are now. Now, let's turn our attention to yields over here on the right side. This is the 10-year US Treasury yield. And this yield, you can see that it's been an upward stride throughout this whole period, an upward channel that we can draw on the point and figure chart. We can count point and figure horizontal counting methodology analysis on yields. Very slick. They work very well. We've looked at them repeatedly in the past. They've served us nicely. Currently, we have 10-year yields in the neighborhood of 4.9 to 5%, very close, still in the 4.9s. And we are now starting to throw over the top of our channel, which is an overbought condition, throw over an overbought, which can throw over substantially because we're getting a buying climax on yields. We have to turn our thinking inside out. Selling climax on prices on interest rates, buying climax on yields. And so here we have the 10-year US Treasury starting to show signs of climactic surges upward. We have a count objective of 5% to 5.3% in this upward stride of yields. And so that last push up, which would be over the top of this trend channel, could be a buying climax of sorts. It may result in a pause, or it may be the conclusion of the advance in rates. Too early to tell at this point. We just know that there could be a climactic event which tends to culminate and terminate an advance in the trend for a period of time, possibly with a reversal into a new downtrend. Again, too early to tell. So here we are with these. Let me clean this up. And here is the vertical price chart of TLT for you to look at. Here is the area that we've just analyzed. And also over here, you can see that this looks an awful lot like ice. And ice is that period where you get no real lift in the market. It shows that there's no good demand. Demand is pretty much absent. Generally, on the rally phases, volume will be low and declining. And that's exactly what ultimately happened, is this hinged into a very important downward stride. And note here in the conclusion of this, the gaps. This is a climactic decline here that goes down to the 84 level. And this is very climactic, and we have counts that take us to 77. So it's not uncommon to see a climax occur in stages and for the volatility to remain high. This is the reason it's very, very tricky to buy selling climaxes, because they can persist for a long time. There's a lot of supply present, and it becomes panicky with lots of gaps and so on. And it really is an attempt to catch the falling knife. So I would counsel, be very, very careful about a tendency to want to buy selling climaxes, because until you have the selling climax and the automatic rally, you don't have the evidence that the low, or at least the start of an accumulation or a trading range, is in place. Okay, moving on. Let's take a look at gold. Gold is interesting here for a couple of reasons. The chart on the left shows the downward stride of prices through this area and then becomes oversold with a throw under of the channel. And this is since May. More of a local event, unlike bonds, which have been going down for more than a year, maybe 2 years. You have, in this case, a very important decline that comes at the late stages of this event of falling prices. Well, look at this. This has a climactic quality. Gap, 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 big strides, very high volume on this decline. Look at the response. Look at what happens at the conclusion of this drop. A reversal upward. Now, this is prices through today and the 19th. And look at how it completely took back that last leg down in very, very short order. We will watch to see whether the resistance at this zone has influence on prices and can stop the advance and potentially cause a bigger cause to be built. But this is, and again, this is just daily prices, but very interesting turn of events for gold. Also keep in mind that this is all happening into the end of the third quarter, start of the fourth quarter. So treasuries, look at how they're accelerating here in October into the end or the beginning of the new quarter, which is oftentimes, it's very volatile. October often has a crash cycle in it. And so keeping that in mind, and look at how gold went right down into the end of the third quarter, clocked in its low, and reversed very sharply thereafter. Change of character. Keep that in mind. Now, very briefly, looking at the point and figure chart on the right, you see here that we have a small count in blue, and this count takes us down and right to where it stopped and needed to consolidate, build a new redistribution. Well, this count worked nicely as a swing count. Then we take the larger count that occurred thereafter. This count here in green took us down to 171 to 168, 166 on the GLD. And look, we went right into the middle of that range on this climax that occurred into the end of September. And this redistribution count gave us a confirming count of the larger distribution area and confirmed this low. You can see in gray, I put in where this low was, in the way up, and this also tended to be a support area. And this is currently 183, which is right here. So that's gold at this time. Talk about distribution for a minute. We're going to get into distribution structures very briefly. And as you see here, these distribution schematics have important implications for us, because you can see here that this has a hinge in it, and hinges and keep this in mind. I'm going to show you a stock that just had such a hinge, uh, and then a sign of weakness right here, where it breaks down, goes through key important lows in or the earlier part of the structure. And this is a slightly different view with an upthrust after distribution, but both are seen often and can be used. The schematics can be used to help us to understand where we are. So keeping that in mind, let's go to the NASDAQ 100. This is driven by the Mag 7, the Magnificent 7, and the other growth stocks that have been so gloriously strong since the October low and the December low, and has worked out really well for trading purposes in 2023. But now I'm going to make the case to you that we have the conditions present for a possible distribution on a local basis. And this is why this chart, I think, is one of the critical charts in addition to interest rates. So let's go here and let's zoom in. I want to show you, this is the 2021 distributional top. This is right here. And then we have talked about this repeatedly: preliminary supply, buying climax, automatic reaction, secondary test, and then a sign of weakness, last point of supply, another lower low sign of weakness, and then another last point of supply. And so a classic structure, a little different from the schematics, but it doesn't matter. These are principles, not patterns. And so we're looking for tape reading principles in these charts. And then if I have time, I'm going to show you the stocks above their 50 in the NASDAQ comp and the NASDAQ 100. But now let's go over here. You've seen this. Well, now this structure that we're in currently looks remarkably like the structure that occurred at the bull market peak late 2021. So, but it's on a smaller scale. The structure is a little smaller than it was back at the bull market peak, but preliminary supply. So that tends to stop this advance, cause a slight correction, and then the buying climax follows with a more important reaction, which we call an automatic reaction. This sets up a range-bound condition. So we have support here, resistance up here, and then a secondary test rally that goes to a lower high below the buying climax follows, typically on lesser volume. And it's, I guess, a little hard to see. You can see the volume. Look at the 10-day moving average of volume, diminishing volume on the advance. And note how high the volume is into the climax. So right into preliminary supply and buying climax. Then we have a sign of weakness, and we call it this because it takes out the support low and makes a lower low than the prior one. A rally back up into an LPSY on even further diminishing volume. That is evidence that demand is waning. It's very weak demand. And so now we do not have a breakdown out of this area. We actually had two signs of weakness in this distribution here and here. We may get that where we get another sign of weakness and another rally into another LPSY, but we don't have to. And then let me just point out, and I'm going to come back to this later, but look at how poor the breadth is looking at the stocks above their 50-day moving average. And this is one of the indicators I really like. Look at the NASDAQ composite has very few stocks that are above their 50-day at this time. Very weak market. It's hard to imagine a market with so few stocks driving prices higher being able to stay up. More on that in a minute. Okay, so distribution structure, and I know you all being Wyckofians are saying, well, don't we need to do a point figure chart on that? Well, yeah, let's do that. So here is a chart. This is through September 20th. I believe I've shown this chart here before. So, and we've talked about how distribution appeared to be forming much earlier. Look, we were still in the upward stride of this channel at that time. We took a count 328 to 318, which takes us out of the channel, and it's a pretty substantial decline from the 364 level. So what has happened since? Now, it's only become bigger. This is the same count, 328, 318 down here, so that you can see how much potential there is for a drop. But as you have already surmised from looking at this chart, that our structures become bigger. So I'm using this as a swing trading objective with the idea that if we break down and get another sign of weakness, look at this, sign of weakness, and another one here, we're going to take this bigger count, which will give us lower objectives. Let's note that the volume on the declines in this point and figure chart are substantially higher than on the up columns. Supply is present. Okay, last thing I'm going to show you, and then we'll be done. And this is important. This just happened last night, and that is that Tesla reported earnings. Tesla's one of the Magnificent Seven, as we all know. And this Tesla and these Magnificent Seven need to continue to show strength to hold up the NASDAQ 100, the triple Q ETF, which is pretty much the same index. And so these stocks are really important to show the way, to lead prices higher, and that did not happen. Earnings came out last night after the close, and we've had a decline of 22 points. And you can see here that the currently at gosh, I can't even see that. Poor me. 219.68. But this 212 low over here is very important support. And tell me that this doesn't look like on a local basis. Look at the hinge. Remember how we saw a hinge on the distribution? So we had an early sign of weakness, which showed up on our schematic. Then we have a rally to a lower high, and then a hinge formed towards the end, and then we get a more important sign of weakness. Very consistent with the distribution structure we just looked at. So we can actually go in and label this whole structure. Let's do that right now. And so here we have preliminary supply. We have a buying climax. We have an automatic reaction. We have a secondary test. A hinge develops through here and resolves to the downside. Volume is coming in, which shows supply is present. And now this whole structure looks like potential distribution. And so this is a very important, I think, local structure that we need to be respectful of and recognize that it's one of the Mag 7. And we will want to watch during this earnings season whether or not other Mag 7 stocks give us negative surprises on earnings. I don't know. I don't know what the earnings are going to be. They could get better earnings and still go down. They could give worse earnings. Who knows? But this is a precursor to how the quarter could go for earnings and for the Mag 7. So here is a point and figure chart of what we just talked about. Now, me being rather conservative in my counting methodology, I'm taking 2 swing counts. This is, let's go back. I'm taking this count area first, and then I'm taking this count area, the hinge, next. This count area goes down to as low as 200. Look, we went right down and fulfilled the count objective by getting into the range of this count. And so, and then this produced a rally. Now we see the hinge, and this hinge has been broken, but this hinge produced a count. And so this count here across this area, and I didn't put the count up, but this particular count takes us down to 212 to 204. And we are close, but not quite there yet. Easily have follow through in the next couple of days that takes us into this count zone right here. Okay, so I'll clean this up, and then let's look at the count for the whole thing, which this is 39 across. If this is all distribution, and it's a big if at this point, then this counts all the way to 140. And 140 is a substantial decline, and not to a lower low. So for Tesla, but 140 would be an important decline for this very important Mag 7 stock. And then the last comment that I have is I want to talk about the NASDAQ and the New York. Both of them are really the same principle, and that is stocks below their 200 or above their 200 day. And I want to point out that when you get into an oversold reading in this, meaning that you have very few, less than 15% of stocks above their 200-day moving average, people like to look at this as an oversold condition. Well, in fact, it is oversold. But keep in mind, when we talked about selling climaxes a few minutes ago, is that the selling climaxes often occur, the most important and dramatic psychological price damage in these indexes occur when you get into the extreme oversold condition. And I put a yellow area around where in 2018, 2020, and so on, and showed the volatility that came in when you had this oversold. Now, we don't have a deep oversold here, but we're moving in that direction. And this is often the time when you can have the most volatility. So oversold can be a very tricky place to be in these indicators. And I want you to think about that. And my experience is that when you get below this 35% level on this indicator, and this is one of my most important breadth indicators, is that this is where you can start to get real price damage in the indexes, where they can fall easily and effortlessly. And so you can see that here, and now you're back below here, and you're starting to move with some ease. We'll see if that continues. And with that, that's my program for today. I hope that you found these studies interesting and important as I have. And I'm losing my voice. I apologize, but thank you for being here. Thanks for sending me input about studies and things you'd like to see in the future. And we'll see you next time on Power Charting. So long, everybody.